Yesterday, I did a video in which I projected that based on my analysis of the debt crisis, which is going to be stimulated by the fact that servicing debt is basically doubling and if not tripling in cost, that these costs will show up on the bottom line of corporations and their earnings will come down. Well, if the price of their stock is a multiple of their earnings, then that means the price of the stock is going to go down. And Homer writes me in the comments and says, hey, you're beating a dead horse. Everybody knows this. And just move on and let's talk about something else. Well, Homer, I feel like Michael Burry of the Big Short, that nobody's paying any attention. The Dow and the S&P 500 are up between 1 and 1.5% today. And yet, I just proved to you that between this now and this time next year, the earnings of the S&P 500 are going to drop somewhere around 50%. And I'll show you today that the Dow earnings will drop about 25%. It can't be stopped. Now, you may say, well, that's just, they'll price it into their product and it'll change. No, because my gas is going up and my food costs are going up. So I'm spending less at Amazon. I'm scrutinizing my expenditures. Well, if I'm doing it and I'm pretty well off, I suspect everyone else is doing it. And to ignore this it's suicidal if you're an investor. So I want to show you what I found about the Dow and how I've broken it down. And it's much easier to understand because there's only 30 stocks there. There's 500 and you can't go through and scrutinize each one of them. You can do that on the Dow. So stick with me and let me show you this.
Best of Us Investors presents Kerry Griegmeyer.
This is a chart similar to the one that I showed you yesterday on the S&P 500, but it's on the Dow. And there's only 30 stocks in the Dow, so it's a little easier to understand. But it points out some real discrepancies that you have to figure in when you're analyzing what is the increase in cost of debt going to be for the Dow. And where it leaps out is in the banks, Goldman Sachs and J.P. Morgan. When they take on, and let's look at what their current debt is, $301 billion, and in the case of J.P. Morgan, 537. Well, what you need to understand is when you deposit money at Goldman Sachs or J.P. Morgan, that becomes a liability. They have to pay it back to you. So their debt is extraordinarily high. And relative to the cost of debt of other people, their cost of debt is low because they aren't paying you much of an interest rate on the savings that you put in there. So that throws these numbers askew. As you can see here, projected income of J.P. Morgan or for 2023 was $47.8 billion, and it's projected, even though the cost of debt is going up, that their projected income will be 51. It's even more apparent on Goldman Sachs. Their income in 23 was $8 billion. It's projected to be $23 billion, again, because the cost of their debt is substantially lower than everybody else. So you take them out, you leaving them in, there will be a decrease in earnings. That is to say, what I've done is said this is American Express's earnings in 23. This is what it's going to be projected. Not that much difference. And again, there's something in the lending business as well. But look at Amgen. Amgen's income in 23 was almost 800. That's hundreds, thousand, million, billions. And it's going to drop to 392 because they are paying on their current debt. There you're seeing that my spreadsheet is updating as we speak because some of the numbers changed. So Amgen's current debt is $61 billion. Their interest payments are $2 billion, but they're going up to $6 billion. And that's what's causing the drop in their earnings. So if we take the banks out of this, and that's what I've done down here, here we have a total of income. This is total of income minus the banks. Here we have current debt. This is with the banks, this is without the banks, and then we come over here and we show the difference. The difference will be, relative to this number, a drop in earnings, minus Goldman Sachs and JP Morgan, a drop in earnings of 23%. So if their earnings go down 23% and the price of stocks is considered a multiple of earnings, then we can expect, as these loans mature, and I've shown you, and here's the chart that shows how they're going to mature. As they mature, the earnings will come down. Now, if you also put into that equation that the cost of living of you and I, the consumer, and 80% of our economy is the consumer, if you put that into the equation as well, well, then that 23% looks light, okay? And let's look at some of the corporations that really stuck out to me. This is 3M. 3M's earnings last year were a negative $1.4 billion. With the increased level of debt, it's going to go up from 1.4 to 2.6. That's pretty striking. Walgreens had a loss of $3.8 billion based on their debt service increase in cost. That's going to go to $6.9 billion. If you aren't factoring these into the cost of your holdings, then you're in for a big surprise. This is Disney. Disney showed earnings in 23 of $2.3 billion. Their cost of debt is going to go from 1.7 to 4.7, and that's going to give them a loss of $650 million. So if you own Disney and you want to own it for the next 20 years, okay, maybe. If, on the other hand, you don't want to get impacted by a substantial drop in their value as a result of the increased cost in earnings, and again, the families, young families who go to Disney for vacations are now paying more for gasoline. They're paying more for chicken and beef and everything in the grocery store. You can't expect that this is just going to go away any more than you could expect that there will be no unintended consequences of a banking crisis in 2010 or a pandemic crisis in 2020. You have to factor it in and then make your investment decisions. That's all I'm here for, is to learn how to access all their spreadsheets, all their balance sheets, all their projections, and then give you the ability to make a good investment decision. Now, I share this. I share my portfolio. I share my buys, my sells, my holds. I ask Mark to come in and do beyond financial analysis, do technical analysis, and give me feedback, to give me guidance. There it's changing again, on what I should buy and what I should sell. So if you want that kind of current information to help you make better investment decisions, I'm here for you. You'll find me on the bus, okay? And you'll find the bus at our website. Go down below, Best of Us Investors. Go into our different levels. This is our platinum level. I charge you $60 a month for my work, and I share it with you. And then we have a Discord. We've had some change in personnel, so we're rebuilding the Discord to make it better. and make it more functional for you. And that's what I like to say. I want to change investing to a team sport. And I want you on the team, and you get on the team by getting on the bus. All right, I'll talk to you more about this. And Homer, I'm not going to let this die because I think it's too important. And I think it would be negligent on my part to say, okay, that's all I'm going to say about this. I'm going to track it. I'm going to watch these numbers change, and I'm going to give you current information on how to make better investment decisions. Talk to you again tomorrow.